Take a look at this chart tracking U.S. Treasury yields over the last 2 decades. Right at the end, you see this sharp spike jumping up to meet a dotted line we haven't touched since the 2008 financial crisis. That sudden surge has Wall Street whispering about an old financial ghost story making a comeback, the return of the bond vigilante. Skyrocketing government yields set the baseline for consumer debt, creating higher, crippling borrowing costs for anyone trying to get a mortgage or a credit card. According to the analysts at DoubleLine Capital, the comfortable era of 0% interest rates we enjoyed for years is officially dead. Instead, the vigilantes are out in the open and actively thumping their chests. The bond market has shifted into a position of active hostility, threatening to choke the global economy to force fiscal discipline on world governments. This financial contagion is currently sweeping through every major developed nation simultaneously. This chart shows bond yields across several major economies. Based on data from Aberdeen and DoubleLine, you can see the UK gilts, Japanese JGBs, and German bunds all surging upward in tandem to hit 10-year peaks. If we fade those international lines and isolate the United States, the 30-year Treasury yield crosses a stark red threshold at 5.18%. Bank of America notes that this upward pressure shows sheer fiscal concern is now overpowering the Federal Reserve's monetary policy. 2 major macroeconomic triggers are fueling this fire. First, global tariffs are throwing sand into the gears of international currency flows, increasing the cost of financing debt across borders. Rising geopolitical tensions in the Middle East have created an inflationary energy supply shock, pushing up prices and making long-term bonds a less attractive investment. The free market has registered this convergence of global instability. In response, it is mathematically demanding a higher price for taking on any government debt. The United States government, however, is not defenseless. It possesses powerful institutional mechanisms and will not surrender control of its debt to the market easily. Analysts from UBS suggest the vigilantes might actually be retreating into hiding. Political leaders simply cannot afford to sit by and let skyrocketing borrowing costs crush everyday homeowners. Over at Alhambra Investments, there is a distinctly contrarian view. When you measure today's debt against the country's historical capacity to handle it, this situation may not be the 5-alarm fire the market claims it is. Looking at this bar chart comparing debt service costs, you can see that the current cost as a percentage of the total GDP is actually lower than it was back in the early 1990s. The government can also deploy a tactic known as financial repression. This happens when regulators forcefully stabilize the market by easing banking leverage ratios, essentially changing the rules so domestic banks are required to buy and hold more treasuries. There is a historical precedent for this. After World War II, the government used yield curve control to artificially cap interest rates across the board, forcing them to stay low so they could manage their massive war debt. The state has synthetic tools ready to temporarily freeze the free market, proving that bond vigilantes do not hold absolute power over the economy. Underneath all of these tactics lies the government's ultimate baseline advantage, the exorbitant privilege of the US dollar functioning as the world's reserve currency, guaranteeing a constant baseline demand for American debt. But that privilege has strict limits. The investment firm Aberdeen warns that the market is now demanding a higher term premium. The term premium is the mandatory extra compensation that investors demand to hold long-term debt, especially in a world currently plagued by continuous inflation and supply shocks. This chart projects Bank of America's math. If elevated rates hold, the cost of interest on U.S. debt will climb aggressively, hitting $2.5 trillion by 2036. To put that in perspective, that consumes nearly 30% of all federal revenue. The financial phantom hasn't crashed the economy today. The government still has the shields and the institutional weight to delay a total meltdown. The bond vigilantes are playing a long game, waiting in the shadows for compounding math to eventually break the machine.